Today, we're taking a comprehensive look at the S&P 500, an essential element of the stock market. We'll cover everything from what the S&P 500 is and why it's important to its performance, investment strategies, and potential risks. Hi there, I am Moss, and on this channel I elucidate the money and the importance of investing. If you're looking to achieve financial freedom, then don't forget to subscribe and hit the like button if you find this video helpful. Now, coming back to the topic, the S&P 500 is like the all-star team of the stock market. It's a collection of 500 of the largest and most influential companies in the United States. Think of it as a snapshot of the American economy, representing a wide range of sectors, from technology to healthcare to consumer goods. When people talk about how the market is doing, they're often referring to the S&P 500. Investing in individual stocks can be risky. You're putting all your eggs in one basket. The S&P 500 offers a way to spread your risk across hundreds of companies. This diversification is one of the key reasons why the S&P 500 is so popular among investors. Instead of trying to pick individual winners and losers, you're essentially betting on the overall strength of the US economy. This makes the S&P 500 a great option for both beginner and experienced investors looking for long-term growth potential. The S&P 500 is a benchmark for the US stock market. When the S&P 500 goes up, it generally means that investors are feeling optimistic about the economy. Conversely, when it goes down, it suggests that investors are concerned about the future. The S&P 500 is widely followed by investors, analysts, and financial institutions. Its performance is often seen as a barometer of the overall health of the stock market. Many investment funds and portfolios are measured against the S&P 500. This makes it a crucial indicator for understanding market sentiment and making informed investment decisions. Whether you're a seasoned trader or just starting out, understanding the S&P 500 is essential for navigating the stock market. Not just any company can join the S&P 500 club. There are strict criteria that companies must meet, and it all comes down to market capitalization. Market capitalization, or market cap, is simply the total value of a company's outstanding shares. It's calculated by multiplying the company's share price by the number of shares outstanding. The higher a company's market cap, the larger and more established it is considered to be. To be included in the S&P 500, a company must have a market cap of at least $14.5 billion. This ensures that only the biggest and most influential players in the market make the cut. The S&P 500 is a constantly evolving index. Companies are added and removed regularly based on their market performance and other factors. This ensures that the index remains a relevant and accurate reflection of the US stock market. Investing in the S&P 500 offers several key benefits for investors of all levels of experience. First and foremost, it provides instant diversification. By investing in an S&P 500 index fund or ETF, you're spreading your risk across 500 different companies. This diversification helps to mitigate the impact of any one company's poor performance on your overall portfolio. Second, the S&P 500 has a long and impressive track record of historical performance. Over the long term, the index has delivered consistent returns, outperforming many other investment options. This makes it an attractive choice for investors looking to build wealth over time. Finally, investing in the S&P 500 gives you exposure to some of the most innovative and successful companies in the world. From Apple to Amazon to Microsoft, the S&P 500 is home to many of the companies that are driving innovation and shaping the future. Now, let's discuss the historical performance of S&P 500, which is a testament to resilience. The S&P 500 has weathered its fair share of storms over the years. From recessions to market crashes to global pandemics, the index has experienced it all. Yet, despite these challenges, the S&P 500 has consistently trended upward over the long term. For example, from 1957 to 2024, the S&P 500 delivered an average annual return of around 10%, including dividends. This means that if you had invested $10,000 in the S&P 500 in 1957, your investment would have grown to over $7.5 million by 2024. Of course, past performance is not necessarily indicative of future results. However, the S&P 500's historical resilience provides a degree of confidence that it can continue to deliver solid returns for investors in the years to come. Now, it's vital to build an understanding regarding the risks involved, the volatility and economic factors. While the S&P 500 offers significant potential for growth, it's important to remember that all investments come with risks. The stock market is inherently volatile, and the S&P 500 is no exception. The index can experience short-term fluctuations in value, and there are no guarantees that it will continue to rise in the future. Economic factors such as inflation, interest rates, and geopolitical events can all impact the performance of the S&P 500. It's essential to have a long-term investment horizon and to be prepared for periods of market turbulence. By staying invested and riding out the ups and downs, you can increase your chances of achieving your financial goals. Now that you understand the benefits and risks of investing in the S&P 500, let's talk about how you can actually invest in it. The two most popular ways to invest in the S&P 500 are through index funds and exchange-traded funds, or ETFs. Index funds are mutual funds that passively track a specific market index, such as the S&P 500. They are designed to replicate the performance of the index as closely as possible. ETFs are similar to index funds in that they also track a specific index. However, ETFs are traded on stock exchanges like individual stocks, which gives investors more flexibility in terms of when and how they buy and sell their shares. When choosing between index funds and ETFs, there are a few key factors to consider. First, consider the fees associated with each option. Index funds typically have lower expense ratios than ETFs, but ETFs may offer more trading flexibility. Second, think about your investment goals and risk tolerance. If you're a long-term investor with a buy and hold strategy, an index fund may be a good option. If you're a more active trader, an ETF may be a better fit. Finally, consider the specific features of different index funds and ETFs, such as their tracking error, dividend yield, and trading volume. Now, to conclude our whole discussion about S&P 500, it is a powerful tool for long-term growth for investors looking to participate in the long-term growth potential of the US stock market. With its diversification benefits, historical performance, and exposure to leading companies, the S&P 500 offers a compelling investment opportunity for both novice and seasoned investors. However, it's crucial to remember that all investments carry inherent risks, and the S&P 500 is no exception. By carefully considering your investment goals, risk tolerance, and the different investment options available, you can make informed decisions that align with your financial objectives. Whether you're just starting your investment journey or looking to enhance your portfolio, the S&P 500 deserves serious consideration as a cornerstone of your long-term investment strategy. Remember, investing is a marathon, not a sprint, and the S&P 500 can be a valuable tool to help you reach your financial destination. Have questions about the S&P 500 or investment strategies? Drop a comment below. We'd love to hear from you. Thanks for watching, and see you in the next video.